Hi everyone, it's David Pryor from Priority Funding and Forward Funding. Today's video is going to be very specifically talking about the private mortgage, the private business mortgage, where we're using solicitors funds / investors funds for a business to extricate out of tax debt or roll out of other debts they need to. And why on earth would we use a facility like this? Okay, so let's get into it and see what they're like. Okay, so your private mortgage solicitors fund facility is typically way more expensive than your bank or good mortgage, your tier one mortgage. Tier one mortgages are in the sixes and sevens at the moment, as of today's sorts of rates, whereas your private mortgages are more on the nines to 12s on a first mortgage and anything from 2% upwards on a second mortgage. Okay, so businesses get themselves into trouble for whatever reason it may be. It could be, and let's use a good example would be tax debt. The tax department is jumping on people at the moment, and rightly so, but that puts stress on businesses. Okay, and what we're trying to do is to find solutions for businesses that can be done quickly. So typically, a a solicitor's fund type transaction can be done in as little as 6 to 10 working days. Now that there are many caveats around that, with how long it takes, with information being provided, with valuations, with solicitors signing off on contracts. I've seen some of these take months because people aren't available. So uh, your typical example is 6 to 10 days to get a solicitor's transaction done. Okay, what they're looking at is they look at a rates notice to see where the property is. So there will be different tiers of lending, whether it be regional or rural, okay, or if city or country, wherever it may be. Now they'll lend more against better access properties than they will against more regional areas. So the lender might say, yes, you have a debt, or you have a debt of 300,000. Your property is worth 900,000. Yes, we can lend you this money. And let's say that for this example, don't owe any funds to the bank. It's unencumbered at the moment. What they would then do is to arrange a $300,000 mortgage. So let's be as conservative as possible. So let's say the rate's going to be approximately 12%, which is effectively 1% a month. Okay. So we start off with 1% a month, and we might even borrow that 1% a month worth of interest, because it's an interest only facility for 6 to 12 months. So we might borrow the interest component on this, so there's no payments for 3 months. Then you have solicitors' fees, setup fees, brokerage fees. Typically, it is going to be approximately 6% fees on top of the interest rate. So if you're borrowing $300,000, 6% fees on that is effectively $18,000. And then you've got your interest you borrow. So your cost may end up being $25,000. But if that $300,000 you get in helps you to win a new contract, uh, pay some bills that are getting incredibly stressful, other, tax, all those sort of things, to pay down credit cards, all those sort of things, then it is worth it. Okay. Generally, these products are used for short term funding. Okay. They can be used for development properties as well, all those sort of things, but for short term funding. Because my strategy around this is within 3 to 6 months of arranging and having funds available on this private lend, we will then roll you out as best intentions to a tier one lender. Okay, so it's a practice that we will not do a second tier lend or a private lend or a solicitor's lend unless we are very confident of an extrication of that product down the track. It's no good you being left with a 12% plus fees transaction if that's going to kill you down the track. All we're doing is delaying the inevitable. No, we make sure there's a solution to roll you out of this in the first place. So let's have a look at a bigger picture here. Okay, you might have call the $900,000 property. Then you have a $300,000 mortgage to ANZ, and you need $300,000 or thereabouts for your business. Well, the lender will look at your current exposure, look at how much they can lend you. In that particular example, 963, they might lend you 230,000. They'll go up to 70% LVR of the property. Okay, that's up to. Some do more, but let's be conservative again. Up to 70%. Okay, then they provide the 230. If their second mortgage, as I mentioned earlier, then it will be 2% a month plus the fees. Again, it is a solution. People sit there and say, why would I pay such a high figure? It's a solution. If that solution involves rolling you out in 6 months' time, 3 months' time, fantastic, okay? Many of the reasons that people do these facilities is they've got themselves in some problems in their payment history with their bank, or they have some negative credit file histories. They've had some defaults or whatever it may be. So the traditional lenders won't lend them money at the moment. So we need to find a solution. So what we do, again, is we fund as much as we can, as much as needed, that will get them out of that issue. And then we help them to say, okay, let's fix your credit file up. Let's not borrow silly money anymore. Let's wait for 6 or 12 months, and your payment history will be good. Because you've got the extra money and you borrowed your interest component, so you're not making any payments. We can actually have your clean history for 6 or 12 months before we go back to the traditional lender. Okay, if you've got defaults and all those sort of things, then we can help with agencies who can remove them if at all possible. But at the worst case, number one, we can pay the default, which is better than not being paid. And number two, we can then help your business to build better profits because you don't have as many overheads. We can help your business to show serviceability moving forward to then get that better facility. Now, we're doing one at the moment for somebody where we're doing a difficult loan to start with today. In 3 or 4 months' time, we will go to a second tier good quality lender, but maybe 2% higher than the traditional market. And we do that because at the moment they won't fully qualify for the best loan, but they do qualify for the next best loan. And all of a sudden, then we're showing a very clear exit clause from the difficult loan into a great loan or a good loan, and then third tier after 12 or 18 months into a much better loan again. We will never, ever suggest you doing the solicitor's loan if you don't need it, okay? When we talk to people, we talk to them about the benefits of it takes 2 to 3 months to do a decent mortgage loan. Do you need the funds more before then? No, maybe not. Well, let's just go the traditional way. Do you need it fast? Yes. Why? Let's do the cost-benefit analysis. There's a great little phrase for you. What is the cost-benefit analysis of me using this type of loan? If the benefits outweigh the costs, there's your answer, okay? Again, we need to make sure that we're not going and scattergunning this everywhere. So talking to us and strategizing the best lenders to go to is very, very important. We work many times with accountants to work out the best way to do this. And we work with businesses all over Australia that need and use these facilities with the clear guidance to extricate out in 3, 6, 12 or 18 months' time. I hope that's been helpful. I look forward to helping many businesses in this area and, again, creating solutions for you which help you cash flow wise in your business. This is David Pryor signing off for Priority Funding and Forward Funding. I look forward to speaking to you again in the next video.